All right, let's dive right in. We're going to tackle a question that seems almost childishly simple. But according to our source for this explainer, the debt machine, the answer isn't simple at all. In fact, it might just change how you look at, well, everything.
I mean, really, stop and think for a second. Where does money actually come from? You earn it, you save it, you spend it. It feels real, right? Tangible. But what if I told you that our source today claims that what we all think of as money isn't really money at all? Wild, right?
Okay, get ready for this. 97%. That's the number that just blows the whole thing wide open. Our source says that a mind-boggling 97% of all the money in our economy, it doesn't even exist in the physical world. It's not cash, it's not coins, nope. It's just digits, numbers on a computer screen. And here's the kicker. The core idea from the debt machine, almost all of that money is created by a keystroke, just poof, out of thin air. And it's done by private banks every single time they issue a loan. Now, if that's true, really true, it completely flips the script on what you think is sitting in your bank account.
So here's how we're going to break this all down. First, we'll look at the big illusion. Then we'll jump back in time to an old goldsmith's trick. After that, we'll see how that little trick became the monster global machine we have today. Then we'll get into the messy part, the inescapable debt cycle it creates. And finally, we'll look at what our source warns is coming next for money.
All right, Section 1, the money illusion. This is all about pulling back the curtain, It's about that huge gap between what we think money is and what it actually is, and more importantly, who's really pulling the strings. And our source puts it this way, which is pretty chilling. The question isn't whether this is happening. The question is, why don't they want you to know about it? So right off the bat, this isn't framed as some academic debate. It's presented as uncovering something that's been deliberately hidden. That's a heck of a place to start.
Okay, let's head into Section 2, the goldsmith's trick. To really get a handle on the crazy complex system we have today, our source says we have to go back to the beginning, back to a really simple and very profitable little trick.
And this is the big one, the concept at the heart of it all, fractional reserve banking. The source even calls it the original sin of finance. It all started with goldsmiths, right? They figured out they could write out more paper IOs for gold than the actual physical gold they had locked away. A pretty bold move.
And here's how the trick worked step by step. First, merchants would drop off their gold for safekeeping. In return, the goldsmiths gave them paper receipts. Pretty soon, people just started trading the receipts instead of lugging gold around. Then, the goldsmiths had their light bulb moment. They noticed the gold itself almost never left the vault, so they started writing new receipts for gold that didn't exist and loaned them out. For interest, of course. They were creating money out of thin air, backed by nothing but a promise.
All right, on to Section 3, the modern money machine. So now we take that simple goldsmith's trick, and we scale it up. I'm talking massively. We're talking about the global, computerized, institutionalized system that basically runs the entire world today. And the debt machine flags a few key turning points. That little trick from the 1600s? It got a major upgrade in 1694 when the Bank of England was founded. Its whole purpose was basically to let the government fund a war by turning its debt into spendable money. Then, the whole model got locked in for the rest of the world, really, with the Federal Reserve Act in the U.S. back in 1913.
And believe me, people weren't quiet about this. The source pulls up warnings from people like Thomas Jefferson. He basically said, if you ever let private banks control the money supply, well, your kids and grandkids are going to wake up homeless. He saw giving private companies the power to create money as a massive threat to everyone's freedom.
So here's how that old trick looks today. It's like a magic trick. You go and deposit $1,000 in the bank. The bank has to keep a small piece of that, let's say $100, as a reserve, but then it gets to create 900 new dollars out of thin air and loan it to someone else. And just like that, poof, your $1,000 has become $1,900 in the system. That's the money multiplier effect. And our source says this is exactly how the vast majority of our money comes into being.
And this leads to a pretty mind-bending conclusion. If almost all money is created when someone takes out a loan, it means every single dollar of credit in your bank account is also someone else's dollar of debt. They're two sides of the same coin. You literally can't have one without the other in this system.
So, that brings us to Section 4, the inescapable debt cycle. And this is where the rubber meets the road, right? This is where we answer the big question. Okay, so what?
Why should I care? How does this whole crazy system actually affect you and me?
Well, here's the fundamental problem. According to our source, the system has to have more and more debt all the time. It needs constant growth. Why? Because if people started paying back their debts faster than new loans were being created, money would literally vanish from the economy, and the whole thing would grind to a halt. And what are the side effects of this need for more debt? Well, for us, it's things like inflation constantly eating away at our savings and these wild, unpredictable boom and bust cycles we all live through. And if you want a perfect example of this in action, look no further than the 2008 financial crisis. The debt machine presents this as the moment the system just buckled under its own weight. It was a debt machine that had been supercharged with trillions in new mortgage money, and it just seized up. The whole thing just collapsed on itself.
And what was the fix? You guessed it, more debt. A lot more debt. We're talking an almost unimaginable amount. Since 2008, central banks have pumped over $25 trillion of new money into the global system. I mean, just to put that in perspective, that's more than the entire U.S. economy produces in a year, created out of thin air just to paper over the crack.
So where did that get us? Well, today, total global debt is sitting at over $300 trillion. The source makes it pretty clear. The so-called solution to the last debt crisis was just to build an even bigger, more unstable mountain of debt.
And this is where the debt machine asks a really uncomfortable question. When you have total debt that's more than 3 times the value of everything the world produces in a year, and interest is piling up on that every single second, is it even mathematically possible to pay it all back? Or is this a game of musical chairs that's just designed to keep going until the music stops for good? And that's the perfect setup for our final section, the future of money. If the current system is unsustainable, what comes next? Well, according to our source, the next evolution is all about one thing: control. Total control. And this is the big warning shot at the end of the book: central bank digital currencies, or CBDCs. Now, this is digital money that would come straight from the government, not from private banks. They'll sell it to us as being more efficient, faster, better. But our source warns it's the ultimate tool for control. Imagine a world where every single thing you buy is tracked, where your money could have an expiration date to force you to spend it, where your account could be frozen with the click of a button, where what you're allowed to buy can be programmed from the top down.
So let's boil it all down. What are the big takeaways from the debt machine? 1. Money as we know it is created from debt by private banks. 2. The whole system needs us, all of us, to stay in debt for it to survive. And 3. That inflation you feel eating your paycheck, it's not a bug, it's a feature. It's how the system works.
And this is where we leave it. The source doesn't really ask if a system like this will collapse. It basically says history shows that all systems based purely on ever-expanding debt eventually fail. So the final haunting question isn't if, it's when.